Because the reality is, if you look at the past 3-4 weeks, really 6 weeks actually, a lot of the economic data has started to come in a bit softer. This is definitely the case in the U.S. Most economic data points in the U.S., whether you look at some of the PMI data, obviously the GDP data that came out, a lot of the economic data points in the U.S. seem to be indicating a soft patch. A soft patch that would be driven, I think, by the fact that the low-end consumer is now getting properly squeezed. That the rising cost of everything, whether your car insurance, your home insurance, your local taxes, your school fees, your food bill, the you name it, it's gone up, and that this is now starting to squeeze incomes. And you're starting to see anecdotal evidence of that, right? You saw it in the Starbucks results, you saw it in the McDonald's results, you saw it in the Target results. So there are signs that perhaps the U.S. economy is starting to roll over, and therefore, if that's the case, it's not surprising that all the cyclicals, again, the copper stocks, the energy stocks, all that stuff, pulls back. So that's one.
On this episode of the Finance Podcast, I have the pleasure of welcoming on Louis Gave. Louis is the founding. Sorry, probably Louis is the right way of saying it, but founding partner and Chief Executive Officer of Capital. So, Louis, thanks so much for coming on the podcast today.
It's a pleasure to be here. Thanks so much for having me. Nice to meet you.
Yeah, nice meeting you too. And I look forward to speaking. I was just saying that I flew back from Australia through Shanghai recently, and it's amazing to see kilometers and kilometers of just factories everywhere. We'll get to China a little bit later. But just to start, what is your current outlook on sort of what we're seeing in global markets currently?
Oh, I mean, I could go an hour just on that. Look, my outlook right now is that to be perfectly honest, I've just had a rough 3-4 weeks. I think if you look at everything was moving along quite swimmingly from my view of the world. So my outlook was that growth in the world is going to be better than people expected, because growth in emerging markets was going to be better than expected. That China had basically bottomed, and with all the stimulus that had been put in, China was picking itself up from the floor. And that in a world in which China was doing marginally better, emerging markets were humming along, you wanted to be long emerging markets, of course, but you also wanted to be long commodities. So that was how I came into this year, and it was going all pretty well up till about mid-May, or mid-April to mid-May. I think if you look at since mid-May, copper stocks have been smoked, energy stocks have been smoked, gold and silver miners have been destroyed. The Chinese stock market's down about 8%. The Mexican stock market in US dollar terms is down about 20%. Now, granted, part of that is the election, but the past 3-4 weeks have been very tough for people who sort of invested for this worldview. And instead, what you've seen is an S&P 500, a NASDAQ that have reached all-time highs, but have reached all-time highs on the back of just a handful of massive mega cap stocks. What's quite interesting is so far this year, the S&P 500 I think is up 13%. The S&P equal weighted is up 4%. So that 9% gap is, in historical terms, it's a big gap for the past 6 months. And so, yeah, I think it's a market that leaves most people feeling frustrated and miserable when everything is just a handful of stocks. Whether Nvidia, past few days it's been Apple, but it leaves most people extremely frustrated, unless of course you're massively long Nvidia. But if you're anything else but that, it's been the past 3-4 weeks have all of a sudden gone from a pretty good year to a much more challenging year in just 3 or 4 weeks.
And are those things interlinked? So I guess you said, emerging markets, you mentioned Mexican election, that's probably influencing Mexico, but for the other markets, what is driving this shift?
Yeah, to be honest, I'm scratching. I'll be dead honest. I'm scratching my head. I think it could be one of many things. Perhaps the simplest and most obvious explanation is that the whole AI craze, Nvidia, et cetera, is just sucking the oxygen out of the room. It increasingly feels that people are just selling everything just to buy Nvidia. So perhaps we don't have to overthink it. Maybe it's just that. But I think we have to be open to other possibilities, because Nvidia might be the tree that hides the forest. Because the reality is, if you look at the past 3-4 weeks, really 6 weeks actually, a lot of the economic data has started to come in a bit softer. This is definitely the case in the U.S. Most economic data points in the U.S., whether you look at some of the PMI data, obviously the GDP data that came out, a lot of the economic data points in the U.S. seem to be indicating a soft patch. A soft patch that would be driven, I think, by the fact that the low-end consumer is now getting properly squeezed. That the rising cost of everything, whether your car insurance, your home insurance, your local taxes, your school fees, your food bill, the you name it, it's gone up, and that this is now starting to squeeze incomes. And you're starting to see anecdotal evidence of that, right? You saw it in the Starbucks results, you saw it in the McDonald's results, you saw it in the Target results. So there are signs that perhaps the U.S. economy is starting to roll over, and therefore, if that's the case, it's not surprising that all the cyclicals, again, the copper stocks, the energy stocks, all that stuff, pulls back. So that's one option, and this is occurring. This hypothetical slowdown in the U.S. is occurring at a time when the Chinese data shows that the economy is bottoming, but it's not rip-roaring back. At least not on the real estate side of things. In fact, real estate continues to consolidate. There's no new pickup in construction in China. So, you have both perhaps the U.S. starting to underwhelm what were pretty high expectations, and China not picking up the slack. So that's your second possible option. If your first was Nvidia sucking all the oxygen out of the room, your second possible option is you could say, well, look, the environment is changing. Global growth is actually starting to roll over. It's not going to be as strong as perhaps could have been expected a few months ago. I think there's a third possibility. The third possibility is that we're entering the phase now with simply more political risk. I think you look at the past few weeks, you've had a bunch of electoral results that have clearly displeased the market. You had India that sort of shocked the market a little bit. Mexico, I mentioned earlier, in U.S. dollar terms, the Mexican market's almost down 20% from its mid-April highs. You've had, frankly, results in the European elections that haven't triggered a political crisis, but did leave a lot of investors feeling uncomfortable. And you are starting to see spreads, government bond spreads across Europe start to widen again. And, you've got a UK election to look forward to that, most people think will bring in a Labour government that will, run away with it with a super majority that will allow them to perhaps follow less market-friendly policies. And then, perhaps the most important in the political side of things is that the past few weeks has seen the Western world turn, much more protectionist against China. You had first Biden announced in mid-May a bunch of new tariffs on Chinese cars, Chinese solar panels, Chinese batteries and whatnot. And as we speak, we're waiting for the tariffs that the European Union has announced on Chinese cars. We're waiting to hear what the final number will be. So it's back and forth, but a world in which everybody starts erecting trade barriers against everybody else is also not a super bullish world. So it could be, just like success has many fathers, all these factors could have a hand in what's been unfolding in markets. But the reality is the combination of somewhat weaker economic data, pretty bad policies, because I'm a free trade guy, and I think I look at Chinese cars. I think they're a gift. If you can buy great cars for less than $10,000, that's tremendous news for consumers. But what we're going to do is we're going to make that impossible. So if you add it all up, you have perhaps bad policies with economic data that's deteriorating, and then market signals that show a deterioration in all the cyclicals. And it leaves me, as someone who's very long cyclicals, as someone who's very long emerging markets, it leaves me feeling somewhat uncomfortable.
Yeah, thanks for explaining that. And I guess they have had quite a run up the past 6 to 8
Yeah,
months.
you could say, you
or
could also
so,
just say, look, it's the pause that refreshes. They've, copper stocks that ripped higher. And to your point, the argument for that is the ones that have pulled back the most aggressively have been the copper stocks. I think they're down like 15% in 3 weeks. It's been very tough there, but they were also the ones that went up the most in the previous 3 months. So there is an element of, maybe this is the pause that refreshes, that things don't go up in a straight line and all that stuff. So maybe this is a great buy the dip opportunity. That's what I'm hoping.
Yeah, we shall see. So you mentioned there that there's economic data coming out in the US and I guess other geographies as well, where it's things maybe aren't as good as everyone was thinking. And I guess there's been this sentiment shift. It seems every 6 months or so, people are like, oh, the US is screwed, recession's coming, and then maybe they've avoided the recession. So do you think that this the sentiment is starting to change, where it's like, oh, maybe the US economy isn't as strong as we first thought?
Yeah, I fear we're entering this. And look, I think there's a few reasons for this. I mentioned the low end US consumer getting squeezed. That, to be honest, that's my biggest concern. But I also think we have to acknowledge that we're now, what is it, 5 months before the election, before the presidential election, a presidential election in which one of the two candidates, Trump, says, I'm going to re-extend the Trump tax cuts that expire in 2025, and maybe I'll even add to them. And then the other candidate, Biden, saying that he's going to let the Trump tax cuts expire in 2025. So, if you're today a CEO, an entrepreneur, a business manager, and you think, okay, should I do this, whatever, build a new plant, build a new factory, like do whatever capital spending, maybe you just think, oh, you know what, I'm going to wait till after the election to know what my tax treatment will be, unless there's urgency to follow through on capex. You might as well wait the 5 months now to see what the electoral result is going to be and how this impacts the U.S. economy. So I highlight this because it seems to me that we have all the ingredients for some kind of soft patch in the next 5 months, where perhaps what the consumer pulls back some and capex is on hold until you get the election. Now, of course, you could say, well, then that's like a coiled spring after the election. All the capex that has been held back will take place then. Very, very, very possibly. Yeah, but perhaps also depends who gets elected and what tax treatment all this will incur. So, yeah, I think most people in 2023 ran around screaming recession, recession, recession. And of course, it didn't happen. In fact, quite the contrary. You had super strong US nominal GDP growth. And today, I think people have forgotten about the possibility of a recession. The general perspective is, look, before an election, everything will be done to avoid the recession. But if you end up with a bit of a weaker capital spending from here and weaker consumer spending, again, because the consumer is getting squeezed, it doesn't mean you're going to get a recession per se, but it could easily mean a soft patch of some kind.
Yeah, makes sense. So what do you think this means for, I guess, Fed action? Do you still, I know previously you've spoken where you think they could potentially cut in the coming months. Do you still think that's on the table, or has your perspective changed? Yeah. Okay.
No, I do. Look, I think now we've seen the Bank of Canada cut, we've seen the ECB cut, we've seen the Swiss National Bank and the Riksbank of Sweden cut. The reality is Western central banks are desperate to cut, and they'll jump at any and all opportunities to cut. In fact, the ECB was that much was clear in the ECB release, where they actually upgraded their inflation profile, their inflation target forecasts for 2025 to I think 2.7%. And remember, their target is 2. Well, their ceiling is supposed to be 2. So they actually forecast higher inflation, but they still cut interest rates. That's how desperate they were to cut. And frankly, I think that the Fed is the same. The Fed will latch on to any bad job number, any low US CPI number, or any low industrial production, low manufacturing number to start cutting. Any number that starts to show a bit of weakness, and the Fed is cutting.
Okay, makes sense. So then would you I guess that would be positive markets, everything would blow up once they cut, or you don't think it'll happen sooner?
Well, history isn't very kind to that idea, right? Like usually by the time they start cutting rates, initially you're right. Like the first like week, 2 weeks, 1 month after the rate cut, markets may rally on the rate cut. But deep down, it's usually when they cut, it's because growth is slowing, which is obviously not great for equities. So the historical precedents for the Fed cuts rates and the markets rip higher for a very long time are just not there. So I think we have to be cautious to be position portfolios too aggressively on that premise. What I do think gives in is the US dollar. And that's been one of the reasons I've been very bullish commodities, one of the reasons I've been very bullish Hong Kong stocks. Basically, I think as soon as the Fed starts cutting, the US dollar stops trading at the massive premium where it is today, because the US dollar today is so expensive relative to pretty much any currency out there. So if I think if the Fed cuts, the US dollar probably rolls over, and that is bullish a number of things. Usually, historically, that's bullish cyclicals and it's bullish emerging markets, especially emerging markets whose currencies are pegged with the US dollar, because then the local central banks have to print more money to keep the peg. So if the Fed cuts, I think it'll be very bullish for markets like Hong Kong, markets like Saudi Arabia, UAE, all these markets that have pegged currencies. But that's a big if. We don't have the rate cut yet, so we probably don't need to jump the gun. But you can start doing your homework as to, okay, if the Fed starts to cut rates, if the US dollar starts to go down, what do I want to own in markets with pegged currencies?
Okay, makes sense. And do you think, will inflation continue to come down, or do you see it being a risk of it staying at these levels or even higher moving into the future?
Let me make like a Jesuit priest. I'm going to answer your question with another question. What do you think that you're buying today will be cheaper in a year's time? Especially now that we're slapping tariffs, because you're calling me from London, right?
Yeah.
Yeah, and now you've got all European countries slapping tariffs on all the Chinese goods. So it seems to me that pretty much anything you import from China, which today is a lot, is going to be more expensive a year from now. If you live in Europe, if you live in the United States, anything you import from China is going to be more expensive. I tend to believe that foodstuffs and energy will be more expensive because we've underinvested in those entire supply chains. So, I think that will be more expensive. So, yeah, then you're left with the services, healthcare, insurance, education. But somehow these continue to, like, they always have inflation rates of 3 to 6%, almost regardless of what happens. So per year. So, yeah, I've been an inflationista for years. I remain an inflationista. I think we've structurally shifted our inflation regimes. If you look at the US, it used to be that the target was 2% inflation on average over the course of the cycle. Now, the way you listen to Fed directors speak, they're now targeting 2% as a floor on inflation. In Europe, 2% used to be the ceiling, was the target ceiling. We were supposed to hover between 0 and 2. But there again, in Europe, we're now saying, look, 2% will be the floor, not the ceiling anymore. So, yeah, policymakers, as soon as we get even remotely close to that 2%, which is what just occurred in Europe, of course, as you get remotely close to that 2%, central banks will ease, central bank will push cash in. So, yeah, I think we're now across the Western world in a structurally higher inflation environment.
Okay. And then if we go to China, which is actually probably one of the countries that has had, not much inflation and even deflation. You mentioned previously that you thought that it had bottomed at the start. You were saying maybe that's not the case. So I guess what is your current outlook? Do you still think potentially economically it's troughed and now we're going to see a boom?
So look, I think there's two super important trends in China right now. The first trend, the one that you keep reading about in the FT and the Economist and the Wall Street Journal and whatever financial media you choose to to spend your time with is the continued unfolding balance sheet recession. If you look at the past 3-4 years, Chinese stock prices have gone down by 2/3 from their highs. Chinese real estate is down anywhere from 25 to 50%, depending on the city. Now, I want you to imagine that you're living in the UK and the FTSE 100 was down 2/3, and price of real estate in London was down 25%, and price of real estate in, I don't know, Northampton and Ipswich and Bath was down by 2/3, by 50%. 50%. This is what's happened in China. So imagine that this happened in the UK. Where do you think car sales would be? Where do you think restaurant sales would be, or movie ticket sales? I would venture that they'd be at zero. That kind of a balance sheet recession, it would have blown everybody, out of the water. Now, what's fascinating in China, so you've had this in the backdrop. China has just experienced a hell of a balance sheet recession, but it's basically the economy's come through this test of fire, not unscathed, of course. There's been a lot of bodies along the way, and a lot of victims of this, test by fire. But the economy did not implode because simultaneously you had a second trend. Just as the government told the banks, don't lend to property developers anymore, the government also said to banks, go ahead and lend as much as you want to automakers, solar panel makers, telecom switch manufacturers, anybody doing anything in industry or in tech, they can get access to loans. And so that brings me to everybody in the Western world focuses on the real estate and the balance sheet recession. And meanwhile, perhaps the more important macro trend is the fact that China is now basically leapfrogging us in industry after industry. They're producing better cars for cheaper. They're producing better tractors for cheaper. They're producing better nuclear power plants for cheaper, better high-speed rail for cheaper, and so on and so forth. And so this is a super, super important trend. And what's fascinating to me is most Western investors will want to talk all day whether Shanghai real estate prices are going to go down or up another 10%, which really isn't going to impact their lives. And it's at this point, it's no longer going to impact the markets. At this point, it only matters if you own Shanghai real estate or if you're thinking of buying it. Meanwhile, 2 weeks ago, BYD released a new BYD Chin car, a car with it's a hybrid car that can do 2,000 kilometers on one tank of gas. So you can drive from London to Rome and never have to refill. Now, this car is revolutionary. You can question whether it's going to bury and just kill off the entire electric vehicle industry, because what's the point of buying an electric vehicle and deal with the range anxiety and the recharging times, etc., when you have a hybrid that is so efficient that it uses so little gas, 3 liters per 100 kilometers. It uses so little gas that it's like, okay, the pollution impact of this thing is really fairly marginal. So it's and now here's the fascinating thing: is this car is sold for 100,000 renminbi. That's $14,000. And it's in my mind, it's now the best car in the market. So we should be talking all day about this. This car is going to upend one of the most important industries in most Western industrial countries. But instead, we talk about Shanghai real estate, which is now no longer that important. Now, this is all a very long-winded answer to your question, but when you look at China, I think because we've all focused on the real estate story, people are too negative. People are waking up to actually the positive story about China, which is the moving up on the supply chain. Now, granted, as China moves up on the value chain, as it becomes a more and more efficient industrial producer, you also don't get you don't get inflation. And I'll finish. I know I'm long-winded, but I'll finish with this BYD Chin story because it's so telling about the evolution of the Chinese auto industry and the Chinese economy in general. If you go back to 2008, when BYD launched its first car, it was the first BYD Chin. It's like a Toyota Corolla. They just do different models over time. The models evolve, but when they did the BYD Chin in 2008, the car if you were working at BYD, you were earning 11 renminbi an hour. That was your wages. And it would take you 110 months to buy the car. Fast forward today, so 2014, so sort of 15 years later, 2024, apologies, 2024, sort of 15 years later, the new BYD Chin, the workers working at BYD get paid 70 renminbi an hour. So their wages have gone up more than 6 times over the course of this period. And here's the fascinating story. It now takes a worker less than 10 months to buy the car. So you've gone from 110 months to buy the car to less than 10 months, which is why, if you look at China, in spite of this massive balance sheet recession, you still have car sales at all-time highs, and you still have restaurant sales at all-time highs and movie ticket sales at all-time highs, because wages have still managed to go up, and they've gone up a fair amount, and so the consumption hasn't completely fallen out of bed.
Hey everyone, sorry for interrupting. I just wanted to extend a massive thank you to you for listening and tuning in, and for your support over these 3 years. So we've had, hundreds of guests that we've welcomed on the podcast. We've had millions of views with hundreds of thousands of different people listening in. So I just wanted to thank you. You know, I started this as a student and now currently working, and I've always done this on the side just because I have a passion for it and I've enjoyed it. And probably similar to yourself, you listen to all these, different YouTube channels and podcasts of people listening to different guests. That's how I started, and I just wanted to sort of take the plunge and be able to have the opportunity to speak to these people, and you've made that happen. So thank you very much. Just myself, don't make any money from this, and it's really a passion project. So thanks for supporting that passion of mine. If you wanted to support the channel, all I ask is if you could like, subscribe, or even comment, positive or negative feedback. I'm always willing to take constructive criticism. I'd really appreciate that. But otherwise, thanks so much. If you can believe it, only 14% of our listeners actually subscribe to the podcast. So if you can, great. If not, no problem at all. Thanks for listening, and let's get back to the show. Okay, it's really interesting. Yeah, thanks for explaining that. So, do you see? Will they have to be a bit smarter with how they've? I guess because there's concern from the West that there's subsidies from the China government for a lot of these industries. Do they need to be? Do you think they'll have to be more careful in terms of how they encourage these industries, or do you think it's just going to be massive tariffs being put on them moving forward? How do you see that? I guess dynamic changing in the future.
So at first, I'd say I think they've been pretty smart. Deng Xiaoping's advice when he left, when he was getting old, and he could feel that his days were numbered. His advice to the Chinese leaders was to basically bide your time, don't overpromise, and most importantly, hide your cards. Don't show your power, don't show our strength, and remain hidden. Now, again, if you look at the past 5 years, all you've had in the Western media was stories about how China's imploding, the bad demographics, the youth unemployment, the ghost cities, the real estate, etc. And meanwhile, they were growing by leaps and bounds in industry. So now all of a sudden we wake up to the fact that they're producing much better cars for half the cost. And yes, the policy response in the Western world is fairly predictable. The only thing we can do is reach for the weapons of tariffs. So we're going to tariff Chinese cars, but fundamentally that means that you're not really punishing Chinese producers as much as you're punishing Western consumers. Now, here's the important part: is the Western world is doing this at a time when exports to the Western world no longer matter as much as they used to. They still matter, of course. Don't get me wrong, but if you go back to a decade ago, China's exports to Southeast Asia were less than half of China's exports to the US. Today, China exports 20% more to Southeast Asia than it exports to the US. So Southeast Asia, Philippines, Malaysia, Indonesia, Thailand, and so on, as a combined market is now more important to China than the US. So I highlight this because, yes, the Western world will do protectionism, but it won't hurt China as much as it would have just again 5 years ago, 10 years ago. And on this, cars again are a terrific example. From nowhere 5 years ago, China is now the biggest car exporter in the world. But all these Chinese cars you don't really see them. You see them a little bit, but you don't see them massively on the streets of Europe. You definitely don't see them on the streets of the United States. Where you see them is on the streets of Brazil, on the streets of Chile, on the streets of Indonesia or Saudi Arabia. So what China's managed to do, I think, is build proper big markets for its products across the emerging world, which at the end of the day is going to be the growing part of the world for the next 10, 20 years because of demographics, because of catch-up consumption, because of a number of factors. So, yeah, I think, look, you can't hide the fact that you're producing a better car for cheaper. Now, it all comes down to whether the European policymakers and U.S. policymakers accept that China produces a better car for cheaper, and that their constituents are thus allowed to benefit from these cheap Chinese cars, or whether their constituents need to be punished for the Chinese productivity gains and not get an opportunity to participate in it.
Yeah, and historically, we see these tariffs actually are pretty bad for the companies that they're trying to protect because they
Of
reduce
course.
innovation. Yeah.
No,
So it
for
means
sure.
that the product's going to
Well,
be, there's going to be such a big divide. Yep.
do you really think, look at the US, do you really think that, Chrysler is going to produce a better car now because they're protected by tariffs, or do you think they're going to produce a worse car? I think that the question, it's a pretty obvious answer.
Yeah, definitely. So the Chinese currency, the yuan, is also been in the spotlight as well because it's, I guess, depreciated quite a lot against the US dollar as well as other currencies. I was there and I was surprised by how
Against the US dollar, not against other currencies. It's close to all-time highs against the yen, close to all-time highs against the yuan. If you look at the renminbi,
if we'd say like the euro and the pound and
not even the
Australian
euro. I mean,
dollar.
the euro but not even. It's really against the. I mean, the dollar's been strong against everybody, right? I mean, the Aussie dollar went from parity to 65 cents. The euro went from 150 down to we're at 107. All-time low for the well, not all time, but the past 20-year low on the euro is 105. We're not that far off. Every currency's been weak. The renminbi has actually been, amongst all the world's major currencies, has been perhaps one of the least weak one against the US dollar. So renminbi's been weak against the US dollar, but honestly, it's not been weak against all these other currencies. The currency that's been massively, massively weak, that is the big anomaly in the world, is really the Japanese yen. The Japanese yen is 40% undervalued on a purchasing parity basis. In the past 3 years, the yen, or the past 4 years, the yen's gone from 110 to 160. That's been the big currency move, and for me, that's mostly what explains the Chinese renminbi relative weakness. Because if you're China, and 5 years ago you make the bet of saying, you know what, we're going to grow through industry. Our bank's just going to lend to industry. We're done with the real estate story. No more loans to real estate. We're putting all our eggs in the industry basket. Then the one way you get screwed in that strategy is if the other massive industrial producer in the world, i.e. Japan, devalues its currency by 30 or 40% and makes itself massively, massively competitive in the process. And this is, of course, precisely what's happened. A yen at 160 is a genuine problem for any industrial producer anywhere in the world.
Yeah. So where do you see that going? Do you think the yen's going to continue to be weak, or I guess once all these countries start cutting, do you think that it's sort of going to come down a little bit?
So let me first say that I've been wrong on the yen. I never thought it would reach 160, because again, it is so stupidly undervalued. It is, having a G3 currency undervalued by 40% is, on a purchasing parity basis, is frankly simply unprecedented. So if it continues weak now, policymakers in Japan no longer want it to go down because it's actually starting to create genuine problems in Japan. I think U.S. policymakers also clearly no longer want it to go down because it's starting to have an impact on U.S. growth. Now, the first point I'd make is that the idea that the yen can go down in a vacuum and not have, macro impacts everywhere strikes me as very odd. And I think you saw this in the first quarter GDP numbers in the U.S. That were supposed to come out at 2.5, and initially came out at 1.5, was then further revised down to 1.3. All of the disappointment in growth came from trade. Simply put, at 160, the U.S. definitely can't compete. And so, look, I think U.S. policymakers now want the yen to come back up. Japanese policymakers want the yen to come back up. Chinese policymakers want the yen to come back up. It seems to me the path of least resistance that the yen will be coming back up. When all the policymakers want something to happen, by hook or crook, they manage to make it happen. So I personally think being short the yen is a very, very dangerous proposition today.
Yeah, okay, great point. Yeah, it's hard to see it going down any further, but as you said, it's we were all surprised it's at 160 already.
Yeah.
But if we look at, so you've talked about how you've been bullish cyclicals, and I'm assuming you still think that's the case. What would have to change for you to say, oh, maybe I was wrong on this, or maybe it's run its course and it's sort of going the other way?
Yeah, I mean, for me, the one thing I worry about, I mentioned it earlier, but it's the threat of a U.S. recession. And here, I'm spending a lot of time right now, looking for anecdotal evidence of any further weakness of the U.S. economy. One area of concern is residential real estate. We all know commercial real estate has been, an absolute bloodbath. But residential real estate in the U.S. had held up, and now it seems to be softening. So that's not a great sign. But you look at things like credit card delinquencies, auto loan delinquencies, and if you start to see these things ramp up, that's a sign that the party may be coming to an end. So again, I'm bullish cyclicals, mostly not because of my view on the U.S. economy per se, but because I firmly believe that people are underestimating the amount of final demand and of just broad economic growth that's going to come out of the emerging markets out of the next year, 5 years, 10 years, and that people have underinvested for the amount of growth that is going to be coming out of emerging markets. And so that fundamentally drives my positive view on a lot of the commodity producers today. But the reality, it's the old saying, when the U.S. sneezes, the world catches pneumonia. If the U.S. enters into a recession, you probably don't want to be hanging out in copper stocks for too long.
Yeah, that makes sense. And as you were saying before, when the US dollar, once they start cutting, it should come down. That's ideally should be beneficial for the rest of the emerging markets.
Yeah, no, you might get that sort of adjustment, which cushions, at the Fed starts cutting, dollar comes down, so commodities can come back up. But before you get there, you might still have 2 or 3 months of rather uncomfortable drawdowns.
Yeah, good point. So, Louis, thanks so much for your time today. Really appreciate it. My last question is, what is one message? Yep, no problem. Yeah, we'll have to do it again soon. But what is one message you'd like people to take away from our conversation?
Oh, good question. Look, I think the one point I would make to your listeners is there's always many ways to form an opinion, and then there's always many ways to challenge your opinion. And there's the two main ways I challenge my opinions is looking at economic data and looking at market data. Now, when the economic data and the market data point in the same direction, it makes things a whole lot easier. You just, you follow those trends. When the economic data and the market data point in opposite directions, things get very complicated. And the natural reaction is just to de-risk. If you're less confident of the signals, then you make smaller bets. And today, I would say that the broad economic data, the story in emerging markets looks great. It's a very exciting story. And again, the data looks good. The market data is pointing you in a different direction. So here you have two conclusions. Great, it's a buy the dip opportunity. Market is giving me a free pass here. Terrific. Or alternatively, you conclude, markets and economic data are pointing in different directions. Let's perhaps not take everything off, but let's just reduce the size of the bets, because the reality is investing is not a sprint; it's a marathon. Uh, you have you have to size your bets so that you can still be playing 6 months from now, a year from now, 3 years from now, 10 years from now. It's a marathon, not a sprint.
Yeah, perfect. And it can sometimes be easy to to forget that and get stuck in the short term, Nvidia booms. But
Absolutely.
yeah, Louis, thanks again. So if anyone wanted to find out more about your work and what you do, where would the best places for that be?
The best place, well, so you can find me on Twitter, but to be honest, I don't spend that much time on there. My handle is Gav Vincent, which is my middle name. It's a JV, Vincent. But you can also, the best place, to be honest, is our website, gavcal.com. And from there, you can be reoriented towards our research, towards our money management, towards our private wealth, depending on where you live and all these different things. So, yeah, the best place to go is our website, gavekal.com.
Perfect. I'll put that in the description for our listeners. But thanks again for your time.
Thanks, Anthony.
Perfect. Hey, everyone. Thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right. Thanks again.